In Chapter 7, Part 2, we will look at the use of the asset and the accounting that corresponds. Recall, as we examined in Part 1 of Chapter 7, the term capitalize is used to describe recording an expenditure as an asset. Remember that we do that if the expenditure produces a benefit that will extend beyond the current accounting period. In Part 2, we're going to examine how we allocate the cost to the periods of future benefit. The term we use for this is depreciation. It is the accounting process of allocating to an expense the cost of a capitalized asset over its service life. Visually, here we have an illustration. The cost is incurred at the date of acquisition, but there are future benefits. Depreciation is the process of taking that cost, the initial expenditure, and allocating that to the periods of time where the benefit is used up. Over a number of years, the years are referred to as the asset's service life. Recall that the adjusting journal entry is a debit to depreciation expense and a credit to accumulated depreciation, and that accumulated depreciation is a contra asset. Contra asset carries with it a normal balance that is a credit. It reduces the asset's value on the balance sheet. Net book value, recall, is the equipment or any type of asset's cost less its corresponding accumulated depreciation. In order to correctly calculate depreciation, we need to determine three things: the asset's cost, its service life, and residual value. Service life is how long we expect the company to be able to utilize the asset and generate benefits. Service life and useful life are synonymous. Residual value, which is also synonymous with the term salvage value, is used to describe the amount the company expects to receive from selling the asset at the end of its useful life. There are two different types of depreciation methods that we want to examine and be able to calculate: straight line and activity-based. The straight line method charges to expense an equal amount in each year. The formula is cost minus the residual or salvage value divided by the useful or service life. For example, let's assume that Widgets Inc. purchased a new piece of manufacturing equipment for $46,000. Costs incurred to ready the machine for use, things like installation and testing, totaled $8,000. The expected useful life of the machine is 10 years, and the company estimates $4,000 of salvage value. The total capitalized cost will be $54,000, all costs necessary to get the asset ready for use. The service life is the 10 expected useful years, and the salvage value is 4. What will the annual depreciation expense be using the straight line method? We will take the total cost that's capitalized, $54,000. From that we will subtract out the expected salvage value, and we will divide by the useful life in terms of years. The result is a depreciation expense of $5,000 per year. What is the adjusted journal entry that corresponds with this calculation? We will debit depreciation expense, and we will credit accumulated depreciation for the $5,000 that we just calculated. Recall that we need to post to the T accounts. The relevant T accounts that we have in this case are the assets cost, which, recall, was the $46,000 purchase price plus an additional $8,000 to get the asset ready for use. So we have a total cost of $54,000. We have the journal entry that we just recorded here. So we have our depreciation expense totaling $5,000, and we have accumulated depreciation with a credit balance of $5,000. Recall that the depreciation expense will be closed out each year. It is a temporary account. The accumulated depreciation, however, will build up over time. It is the total of depreciation expense recorded each year over the number of years that the asset is used. Understanding that we have the three different T account balances, we should be able to answer the question, what is the net book value of the equipment at the end of year 1? And then likewise, at the end of year 3 or any other year. At the end of year 1, our net book value is equal to our cost less our accumulated depreciation. Net book value is $49,000 in net book value. At the end of year 3, accumulated of 15, our net book value has now fallen to 39, and it will continue to fall as we continue to depreciate the asset over its expected useful life. In terms of balance sheet presentation, we see this format: cost minus our accumulated depreciation yields the net book value. Said differently, this is the balance sheet value. In many cases, the asset will not be acquired on January 1st. We will need to take a partial year's depreciation. Let's go back to our prior example and assume that we had purchased it on April 1st. What would be the correct amount of depreciation expense to record at the end of the year? If we've acquired it April 1st and used it through December 31st, our usage is 9 months. The $5,000 we calculated was for a full year, so we need to allocate that and take only 9/12 of the $5,000. That would result in $3,750. An alternative to the straight line method of depreciation is activity-based depreciation. Activity-based depreciation allocates an asset's cost based on its use. Service life is stated in terms of activity rather than in terms of years. For example, in the case of a vehicle, miles driven, calculating activity-based depreciation is to compute the rate per unit. The numerator is the same as before, cost minus residual value. The denominator differs. Rather than years, we're using expected usage. When we have calculated the per unit rate, we will then multiply it by the actual usage for the particular year in question. Example: if Rebel Company purchases a used truck for $10,500 and estimates that the salvage value is $500, we have $10,000 of cost to depreciate. Rather than use years, we will assume that the truck has a 200,000 mile service life. The first step is to calculate depreciation rate per unit. Our numerator is the $10,000 of expected decline in value, which is the original cost minus the salvage. The denominator is the expected usage in terms of miles. Our per unit rate is 5 cents per mile. We will take that 5-cent rate and multiply it by the actual miles driven each year. If the actual miles driven are 52,000 miles, our depreciation for the first year are those 52,000 miles multiplied by the per mile rate of 5 cents. Total depreciation is therefore $2,600 for year 1. In year 2, if the truck is driven 48,000 miles, we will take those 48,000 miles and multiply it by the rate per unit that we calculated previously. Depreciation in year 2 would therefore be $2,400. And this is the amount recorded in our journal entry. This leads to the question, what is net book value? At the end of year 2, our net book value will be the original cost less total depreciation to date, summarized in the accumulated depreciation account. Our net book value, $10,500 less the $5,000 of accumulated depreciation, leaves $5,500 of net book value on the balance sheet. So we've described two different types of financial accounting depreciation methods, straight line and activity based. Financial accounting often uses the straight line method of depreciation, in part because it's simple and in part because it produces a nice, smooth, even amount of depreciation expense each period. For tax accounting, however, we typically use an accelerated method of depreciation, such as the double declining balance method. The reason a company would use an accelerated method of depreciation for tax purposes is to reduce taxes paid. For financial reporting, we typically prefer high net income. On the books, companies like to report lots of net income. But for tax, we have the opposite incentive, to report low income in order to reduce taxes paid. In most cases, companies are allowed to do both. Use a straight line method of depreciation for books, but then use an accelerated method of depreciation for tax. The result is that companies have two books of depreciation. That covers our discussion of tangible assets. Let's next look at the cost recovery rules for intangible assets. As we've seen, allocating the cost of tangible assets is called depreciation. Allocating the cost of an intangible asset is called amortization. The concepts are the same. Most companies use straight-line method to record amortization of intangible assets. Unlike tangible assets, residual value is typically zero for an intangible. This simplifies the numerator sum because we have zero salvage to subtract out. The credit entry in the case of amortization is not to an accumulated account. Rather, we directly credit the intangible asset itself. Here's an example. Let's assume York Inc. purchased a patent for $150,000. The patent has a legal life of 20 years, but we think its useful life is only 15 years. We're going to use a straight line method of amortization. Amortization expense for the first year would be calculated by taking the $150,000 of cost over its expected service life of useful years, resulting in $10,000 of amortization per year. The entry to be recorded for year one is a debit to amortization expense and credit directly to the patent, not to an accumulated account. The balance in the patent account at the end of the fourth year of its life will therefore look something like this. The cost of the patent was $150,000. As it's amortized, recall that we record a debit to amortization expense, and the credit is directly to the patent account. So each year there will be $10,000 of amortization expense recorded. Year 2, $10,000 for year 3, and $10,000 of amortization expense year 4. At the end of year 4, the patent's remaining value on the balance sheet is reduced to $110,000. We will record amortization only in instances where the asset does have an identifiable life. We will not record amortization if the asset has an indefinite life. Goodwill is a principal example of this. This concludes Part 2, our discussion of the use of assets. When we resume with Part 3, we will examine the disposition and thereby conclude the life cycle of long-term assets.